Good morning. Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the MarketSite, we have Oscar Loynaz. He is the co-founder of M Plus Funds, and we are going to focus on defined outcome investing. Oscar, thank you so much for joining us at MarketSite. Now, this is a new topic for us. What exactly is defined outcome investing? How is that constructed?
Yeah, so first and foremost, thanks for having us, Jill. It's great being here. So defined outcome investments are really a way for you to customize your own ETF exposures that you may have currently in your portfolio. And you do so by aligning that ETF exposure to certain risk-return profiles that you want to meet in order to really meet your goals. They have a beginning and they have an end. So a good way to view it is just to bring up an example. Right. We currently have a fund out there. It's called Defined Preservation 95 Fund. It has a maturity of 3 years. So after 3 years, the fund terminates. Mm-hmm. And what it provides is it allows investors to gain exposure to the S&P 500 ETF up to a maximum return. However, at maturity, they are protected to the tune of 95%. In case the market goes down. So it really defines the maximum loss that you may have with respect to that ETF exposure. So for conservative investors that want to maintain themselves in the market, this is a way for you to remain invested in equities while at the same time have some form of risk management embedded in it. And it's important to look at the prospectus for details, but that's the overall framework of what we do.
So I'm trying to understand this. If it hits at certain level, does the fund close out, or do you return assets to investors if it's hit that specific level? How does that work?
So the fund closes out at 3 years. Right. Defined maturity investments really have a termination.
Regardless of the loss or gain.
Regardless of the loss or gain. So after 3 years, what we do is we look at what the market has done, and if it has gone up, you participate with the market up to a maximum return. Right. But if it has gone down, you really are limited on your losses to the tune of -5%.
Okay, interesting. So how does M Plus Funds, how do you provide these defined outcomes for investors?
So M Plus Funds really delivers a number of different defined outcomes, and they can be really linked to any ETF. And what we do is each individual fund really has one asset and one asset only, which is listed options. And we put together the listed options on a static basis, and what they do is the amalgamation of these listed options converge to a particular defined outcome at maturity. So investors are really buying a fund unit that's a 1940 Act registered fund unit, and those funds really what they have is listed options, and that listed option is really working for you in terms of providing either that capital protection or additional enhanced upside or combinations of those.
All right, now what are some of the benefits of using M Plus funds? I would imagine liquidity and tax treatment is part of that.
So all our funds are liquid on a daily basis. You can buy them at the NAV or sell them at the NAV for as little as $10 a unit, which is the base of the fund. They are tax efficient. They're geared towards capital gains taxation, so they're fairly tax efficient. They're transparent. You open our prospectus and you'll see each individual assets that we have. And we build M Plus funds really based on a strong fiduciary framework. So elements of transparency, liquidity, and efficiency are really paramount to the firm. The other thing that's fairly important is none of our funds have any credit risk. Some of the defined outcome investments that you may have seen in the past are either structured notes, which are bank-issued notes, or equity index annuities. All of those are really IOUs from different institutions which carry with them credit risk. None of our funds have any credit risk.
So it sounds like advisors would use a product like this.
Advisors do use them quite a bit, and we like to say that what we do is really tools for advisors in order to build the portfolios and meet their objectives. Because of the flexibility that we have within M Plus funds, we can really build different defined outcomes to different ETFs on a customized basis. Or we can build funds that are really applicable to a broad swath of investors. So we like to use them advisors like to use them for tools in order to really change that risk return profile of a particular ETF that they have and meet the goals that they want to achieve.
So let's use a real-time example. The volatility that we've seen in the market, let's say from October until now, and we've seen the decline in the major averages. Using an M Plus S&P 500 fund would have protected, let's say, from 15 to 20% downside that we've seen on some of the indexes, because you'd be capped at 5%.
That's correct.
Okay.
And in fact, the capital preservation type of funds that we have become really popular in the past couple of months precisely because of what you just said. And people thinking, well, there's actually volatility in the market and there's risk, and the straight line up that we have seen in the past couple of years may not really materialize itself for the next following years. So again, how can I remain invested and take advantage of everything that equity can provide me from a portfolio standpoint, yet at the same time have elements of risk management underneath your investments that really allow you to achieve your goals.
And that's where the options come in.
That is where the options come in, right? And to be fair, we have other types of M plus funds. I mean, there's people that look at assets that have gone way down and feel that there's an element of value. So how can I construct something that gives me additional upside capture on certain assets that I feel are going to rebound pretty strongly? So there you also use options in order to increase that upside capture and provide people something that really can make an impact in their portfolios.
All right. Thank you so much for joining us at MarketSite.
Thank you.
And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.